We all use money every day, whether we're buying our favorite coffee or saving up for that dream vacation. But have you ever stopped to think about how money is created and why it's so important to understand how it works? Well, get ready to dive into the fascinating and mysterious world of the money system, where we'll explore everything from fractional reserve banking to digital currency and discover how this system impacts our daily lives in ways we might not even realize. Once upon a time, people used to trade goods and services directly with each other without the need for a medium of exchange. For example, you could trade a chicken for a sack of potatoes, or exchange a haircut for some eggs. This was the original bartering system, and it worked pretty well until people started realizing that some goods and services were harder to trade than others. Now, imagine you were a chicken farmer and you wanted to buy some new shoes. You couldn't just walk into the shoe store and offer them a chicken for a pair of shoes because the shoe store might not want or need a chicken. So what could you do? Well, this is where money comes in. The first types of money were objects that had intrinsic value, such as seashells, beads, or precious metals like gold and silver. These objects were valuable in themselves, but they also became a medium of exchange because people agreed that they had value and could be used to buy and sell goods and services. As time went on, people started to use coins and paper money as a more convenient way of exchanging goods and services. Coins were first used in ancient China and were made from materials like bronze, silver, and gold. Paper money was first used in China during the Tang Dynasty, 618-907 AD, and was made from mulberry bark. The modern banking system began to emerge in Europe in the 17th century with the establishment of banks that issued paper money and made loans. This system evolved into the fractional reserve banking system we have today, where banks can create money by lending out more than they have in reserves. Today, money comes in many forms, from physical cash to digital currencies like Bitcoin. It's amazing to think that what started as a simple bartering system has evolved into the complex financial systems we have today. And who knows what the future of money will look like? Maybe we'll be using space dollars or time credits one day. So how is money created? Well, it turns out that money doesn't grow on trees. It's created by central banks through a process called monetary policy. And let me tell you, it's quite the magic trick. Here's how it works. Central banks like the Federal Reserve in the U.S. or the European Central Bank in the Eurozone have the power to create money out of thin air. That's right. They can literally just conjure up new money with the wave of a wand. I mean, the click of a mouse. So how do they do it? Essentially, central banks create money by buying up government securities or other assets from banks, which increases the bank's reserves and allows them to lend out more money. This, in turn, increases the overall amount of money in circulation. But wait, there's more. Central banks also use something called monetary policy to manage the money supply. This involves adjusting interest rates to either encourage or discourage banks from lending out money. If they want to increase the money supply, they can lower interest rates to make it easier for banks to lend. And if they want to decrease the money supply, they can raise interest rates to make it harder for banks to lend. It's kind of like playing with a giant magical faucet that controls the flow of money throughout the economy. And just like a faucet, you have to be careful not to let too much money out at once, or else you'll flood the economy and cause inflation. So the next time you pull out your wallet and marvel at all the bills inside, remember that it's all thanks to the wizards at the central bank who are working their magic to keep the money flowing. The concept of fractional reserve banking and its role in the creation of money. So here's the deal. You put some money in the bank, right? Maybe it's your life savings, or maybe it's just some extra cash you have lying around. But what happens to that money once it's in the bank? Well, here's where things get interesting. Banks don't just let your money sit there and collect dust. They put it to work. And by work, I mean they lend it out to other people who need money for things like buying a house or starting a business. But here's the catch. Banks don't lend out all the money you deposit. Nope, they only have to keep a small portion of it on hand. That's the reserve part of fractional reserve banking. The rest they can lend out to other folks. And voila! They've just created new money out of thin air. Now, I know what you're thinking. Wait a minute, that sounds like some kind of scam. But fear not. Fractional reserve banking is a pretty common practice that helps keep the economy running smoothly. By allowing banks to lend out more money than they have on hand, it makes it easier for people to get loans and for businesses to grow. Of course, there are some downsides to fractional reserve banking too. It can lead to inflation if too much money is created, and it can also make the banking system more vulnerable to crises. But overall, it's a pretty nifty system that's helped keep our economy chugging along for centuries. The role of interest rates in the creation of money. Central banks use interest rates to control the money supply, which sounds boring, but trust me, it's pretty exciting, at least in the financial world. Basically, interest rates are the rental fee that banks charge for lending out money. When interest rates are high, banks are less likely to lend money because they want to make more profit from the interest. Conversely, when interest rates are low, banks are more likely to lend because they can't make as much profit from the interest, so they need to make up for it by lending more money. Now, why do central banks care so much about interest rates? Well, it's because they want to keep the economy in check. If the economy is growing too fast, central banks might raise interest rates to slow down borrowing and spending. On the other hand, if the economy is sluggish, central banks might lower interest rates to encourage more borrowing and spending. But wait, what's the impact of changes in interest rates on the economy? It's like a game of Jenga. If you remove the wrong block, the whole thing could come crashing down. If interest rates are too high, people and businesses are less likely to borrow money, which means they'll spend less. This could lead to a slowdown in economic growth, and nobody wants that. On the other hand, if interest rates are too low, people and businesses might borrow too much money, which could lead to inflation and other economic problems. Types of money, how they're created, and how they work. There are many types of money, and because it is most commonly used, we'll talk first about physical money. Or cash, if you like. Physical cash is generated by the government's printing press. The government determines how much cash to print based on the demand for it. Once the cash is printed, it's distributed to banks and financial institutions around the country. Now, when you use physical cash, the transaction works like this. You hand over the cash to the seller. They give you the product or service, and the transaction is complete. No fancy technology or complicated banking system is required, just good, old-fashioned exchange of goods and services for money. One of the main advantages of physical cash is that it's widely accepted and easy to use. You can use cash for small purchases, such as buying a candy bar, or large purchases, such as buying a car. Plus, cash is accepted everywhere, even in areas with limited or no access to digital technology. Another advantage of physical cash is that it can be anonymous, which means you can make a purchase without leaving a digital trail. This can be particularly useful if you value your privacy or don't want your purchases to be tracked. But physical cash isn't without its disadvantages. For one, it can be lost or stolen. If you lose a wad of cash, it's gone for good. And if someone steals your cash, there's no way to track it down. Carrying around large sums of cash can also be risky, as it can make you a target for theft or robbery. Bank deposits. When you deposit money into a bank, you're essentially lending that money to the bank. The bank then uses that money to make loans to other customers, such as individuals or businesses. The interest rate that the bank charges on those loans are usually higher than the interest rate they pay on your deposit, which means the bank makes a profit. But what are the advantages and disadvantages of bank deposits? First, bank deposits are usually insured by the government, which means that if the bank fails, you'll be able to get your money back. Second, banks often offer interest on deposits, which means your money can grow over time. And third, bank deposits are convenient and easy to use. You can access your money through ATMs, online banking, or in-person visits to the bank. Now let's talk about the disadvantages of bank deposits. First, the interest rate on deposits is often lower than the rate of inflation, which means your money may lose value over time. Second, banks can charge fees for certain transactions or services, such as overdraft fees or wire transfer fees. And third, if the bank goes bankrupt, there's a risk that you could lose your money. Although, as mentioned before, bank deposits are usually insured by the government. Digital currency. Otherwise known as cryptocurrency is the fancy, modern way to pay for things without carrying around a wallet full of cash. So how is digital currency generated? Well, it's created through a process called mining, which involves using powerful computers to solve complex mathematical equations. As the equations are solved, new units of digital currency are created and added to the blockchain, a digital ledger that records all transactions made with the currency. Once you have some digital currency, you can use it to buy goods and services just like physical cash or bank deposits. You can also hold on to it and hope that the value increases over time, like an investment. With digital currencies, transactions can be completed in a matter of seconds, and you don't have to worry about high transaction fees like you might with traditional banking. Digital currency is also decentralized, meaning it's not controlled by any government or financial institution. This gives people more control over their money and reduces the risk of fraud and corruption. Plus, digital currency can be used for international transactions without the need for currency exchange, which can save you money on fees. But, as with any form of currency, there are also some disadvantages to digital currency. For one, it's not widely accepted as a form of payment yet. You might not be able to use it to buy groceries or pay your rent, for example. Also, the value of digital currency can be extremely volatile, which means it can fluctuate wildly in a short amount of time. This can make it risky to invest in, and some people have lost a lot of money by buying and selling digital currency at the wrong time. Plus, digital currency can be vulnerable to hacking and cyber attacks, which can put your money at risk. Central Bank Digital Currency, CBDC. CBDC is a type of digital currency that is issued and regulated by the central bank. But how is CBDC generated? Well, it's created by the central bank and is backed by the government's fiat currency, just like physical cash. It's also different from cryptocurrencies like Bitcoin because it's regulated by the government and doesn't rely on decentralized systems like blockchain. So how does CBDC work? Basically, it's like any other digital currency, but it's issued and regulated by the central bank. Transactions are made using digital wallets, and CBDC can be used for online and offline purchases, just like physical cash or bank deposits. Now, what are the advantages of CBDC? Well, for starters, it's more stable and secure than other types of digital currency because it's backed by the government. Plus, CBDC can be easily monitored and regulated, which can help to reduce illegal activities such as money laundering. CBDC can also be used to increase financial inclusion, as it can be accessed by anyone with a smartphone or a digital wallet, regardless of whether they have a bank account. However, there are also some disadvantages to CBDC. For example, it could potentially threaten the role of commercial banks, as people might choose to use CBDC instead of traditional bank deposits. CBDC could also raise privacy concerns, as the government can monitor every transaction made with the currency. Plus, implementing CBDC could be a complex and expensive process, and it's not clear yet how it would fit into the existing financial system. The concept of inflation and how it occurs when there's too much money in circulation relative to the supply of goods and services. Inflation happens when there's too much money floating around in the economy, chasing after too few goods and services. It's like everyone has a bunch of monopoly money to spend, but there aren't enough properties to buy, so the prices go up. And just like in Monopoly, inflation can be good or bad, depending on how much money you have. If you're a big-time property owner, inflation might be great because you can charge more rent and make more money. But if you're just a regular person trying to buy a house or put food on the table, inflation can be a real pain in the wallet. So, how does all this happen? Well, sometimes the government or the central bank prints too much money, flooding the economy with cash. Other times, there might be a shortage of goods or services, which drives up prices because everyone wants to buy them. The good news is that a little bit of inflation is healthy for the economy, kind of like how a little bit of sugar is okay in your diet. It can encourage people to spend their money and invest in businesses, which can create jobs and stimulate economic growth. But just like with sugar, too much inflation can be bad for your health and your wallet. It can erode the value of your money, making it worth less and less over time. Who benefits the most from the money system? Well, I'd have to say it's probably the lucky ducks who get to swim around in their giant pools of money. Scrooge McDuck style. I mean, think about it. If you had access to an endless supply of money, you could buy whatever you wanted, whenever you wanted, and never have to worry about budgeting or financial planning again. But in all seriousness, there are some real winners in the money system. For example, banks and financial institutions make a lot of money by lending and investing the funds that they manage. And let's not forget about the entrepreneurs and investors who can turn their ideas and resources into successful businesses and profitable investments. Of course, not everyone benefits equally from the money system. Many people struggle to make ends meet, and economic inequality is a major issue in many countries around the world. But as long as there is money to be made, there will always be winners and losers in the money game. Let's be real. Money makes the world go round. It's the fuel that keeps our economy chugging along, and without it, things would grind to a screeching halt faster than you can say bankruptcy. The money system is like a big, complicated machine that keeps our economy running smoothly. At the heart of this machine are central banks, like the Federal Reserve or the European Central Bank, that have the power to create money out of thin air. Now you might be thinking, wait a minute, that doesn't sound right. You can't just create money out of nowhere. And you're right. If central banks created too much money too quickly, it could lead to inflation and all kinds of economic chaos. That's where economic stability comes in. The money system needs to be stable and reliable to keep the economy humming along. Central banks have to strike a delicate balance between creating enough money to support economic growth, but not so much that it leads to inflation or financial instability. Think of it like a game of Jenga. If you pull out too many blocks too quickly, the whole tower comes crashing down. But if you're careful and strategic, you can keep the tower standing tall. When the money system is stable, it allows businesses to make investments and plan for the future, which leads to economic growth and job creation. But when things get unstable, like during a financial crisis, it can have devastating consequences for millions of people. So the next time you're wondering why the money system matters, just remember, it's the engine that keeps the economic train running smoothly. Without it, we'd be stuck in the station, going nowhere fast.